Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. Precious metals are getting more attention from investors, and platinum and palladium are leading the charge. While gold and silver often steal the spotlight, these lesser-known metals offer unique advantages, especially for those looking to diversify. They're not just for jewelry. Platinum and palladium play key roles in industries like automotive and technology, making them practical investments with strong demand. What sets them apart? Both metals are rarer than gold, and their industrial uses create a different kind of market dynamic. Unlike traditional safe havens, their value isn't just tied to economic uncertainty. If you're curious about how they fit into a modern portfolio, you're in the right place. Understanding platinum and palladium. Platinum and palladium may not get the same attention as gold or silver, but they pack serious financial potential. Their rarity and industrial applications make them stand out in the precious metals market. Let's break down why these metals matter beyond just being shiny assets. Properties and industrial uses. Platinum is dense, corrosion-resistant, and has a high melting point, making it perfect for demanding industrial roles. Palladium, while lighter, shares similar durability and is even more resistant to tarnish. Why does this matter for investors? Because these metals aren't just sitting in vaults. They're actively used in automotive catalysts, electronics, jewelry. Their scarcity plays a big role too. Annual platinum production is about 10 times less than gold, and palladium is even rarer. When industries rely on something this limited, price swings can get dramatic, especially when supply chain hiccups hit. Comparison to other precious metals. Gold and silver are often seen as inflation hedges, but platinum and palladium dance to a different tune. Here's how they stack up. Volatility. Industrial demand means sharper price moves. Gold might crawl upward during crises, but palladium surged over 50% in a single year due to auto industry needs. Dependency. Unlike gold, which thrives on fear, these metals need factories humming. A slowdown in car production? That'll hit prices faster than a gold sell-off. Historical performance. Over the past decade, palladium outperformed gold by 300%, while platinum lagged due to slower industrial adoption. If you're after stability, gold wins. But for growth tied to global industry, platinum and palladium offer a wilder and often more profitable ride. Next, let's look at how to actually invest in them. Why invest in platinum and palladium? While gold and silver dominate the precious metals conversation, platinum and palladium bring something different to the table. They combine scarcity with real-world utility, making them more than just inflation hedges. Their dual role as industrial commodities and store-of-value assets creates unique opportunities, especially for investors who want growth without relying solely on traditional stocks or bonds. Diversification benefits. Putting all your eggs in one basket is risky. That's where platinum and palladium shine. These metals often move independently of stocks and bonds, smoothing out portfolio volatility. During economic downturns, industrial demand might dip, but their rarity keeps prices from collapsing entirely. For example, in 2008, while stocks crashed, palladium fell less than equities and rebounded faster. Platinum tends to hold value better than silver during recessions, thanks to its tighter supply. Adding even a small allocation can reduce risk without sacrificing returns. Think of it as insurance against overexposure to any single market force. Supply and demand dynamics. These metals aren't just rare. They're getting harder to mine. Over 70% of the world's platinum comes from South Africa, where aging infrastructure and energy shortages slow production. Palladium faces similar issues, with Russia controlling about 40% of global supply. Geopolitical tensions or labor strikes can squeeze availability overnight. Meanwhile, demand keeps climbing. Stricter emissions laws mean more palladium in every car's catalytic converter. Platinum's role in hydrogen fuel cells is gaining traction as green energy grows. When supply struggles to keep up with industrial needs, prices tend to spike. That's exactly what happened in 2020 when palladium hit record highs amid auto industry shortages. Hedging against inflation. Precious metals have a long history of outpacing inflation, but platinum and palladium add an industrial twist. Unlike gold, which rises on fear alone, these metals benefit from both currency devaluation and real-world usage. Here's how they've performed in past inflationary periods. During the 1970s oil crisis, platinum surged 400% in 5 years. In 2021 to 2022, palladium outperformed gold as inflation spiked, thanks to auto sector demand. They're not as liquid as gold, but their ties to essential industries give them staying power. When cash loses value, hard assets with practical uses tend to hold theirs. How to invest in platinum and palladium. Investing in platinum and palladium isn't as straightforward as buying stocks or bonds, but the extra steps can pay off. You have several options, each with its own advantages and trade-offs. Whether you prefer holding physical metal or want to avoid storage hassles, there's a strategy that fits your goals. Physical metals, bars and coins. Owning physical platinum or palladium feels tangible. You can hold a rare metal in your hand. But it's not without challenges. Pros. Direct ownership. No middlemen. You control the asset completely. No counterparty risk. Unlike stocks or ETFs, your investment isn't tied to a company's performance. Collectible value. Certain coins can gain numismatic premium over time. Cons. Storage costs. Safe deposit boxes or home safes add ongoing expenses. Lower liquidity. Selling large bars can take time, and dealers often charge premiums. Purity concerns. Fake bars exist, so buy only from trusted sources like JM Bullion or APMEX. For small investors, coins are more practical than bars. They're easier to sell and harder to counterfeit. Just remember, physical metals work best if you're in it for the long haul. ETFs and mutual funds. If storing metal sounds complicated, ETFs and mutual funds let you invest without the hassle. These funds hold physical platinum or palladium or futures contracts so you don't have to. Popular options include Sprott Physical Platinum and Palladium Trust. Aberdeen Standard Physical Platinum shares ETF and Palladium shares ETF. Mining-focused mutual funds like the VanEck Vectors Platinum ETF. ETFs trade like stocks, so they're liquid and easy to buy. The catch? You pay management fees, and you don't own the metal directly. Still, for most investors, the convenience outweighs the costs. Thanks for watching Part 1. If you want to learn more about how to invest in these metals and what to watch out for, stay tuned for Part 2. See you there. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.